there's something called self-employment tax, which means so that's always our second option. Our first option when it comes to tax planning is
Remember when he said that there's gonna be a trivia?
yes.
That's the answer, C.
Another year, another pile, numbers stacked up mile by mile. It's time to sit, reflect, and add. Doing taxes ain't so bad.
Let's say you really have a real estate. Let's say that the roof or the HVAC is super old. So then therefore, let's say you're waiting until next year for you to buy the roof or the HVAC. Maybe you could consider investing in it now so that you could get some of that tax benefit this year instead of next year. So it's about playing with the timing is what I'm talking about. The next one is entity choice. This is very relevant to people like Esmeralda, who is a real estate broker or my house flipper. A lot of them are LLCs and also a lot of them just do their business through their personal name. And the problem with that is that when you do that, there's something called self-employment tax, which means whatever is your profit, you need to pay payroll taxes on the entire profit. So let's say if you make $100,000 in profit, that means that you need to pay 15.3% in taxes for that entire $100,000. Whereas if you become an S corp, then you pay yourself in W-2, you will only need to pay yourself payroll taxes for the amount that you pay yourself in the W-2, and whatever you pay yourself in distributions is not required to be subject to payroll taxes. So
All of this just applies to me, right? Because you keep saying my name.
we can say here, it's easy to pick on since you're here.
Thank you.
All
I'm
right.
glad that you pick on me.
Yeah, we mentioned about the time difference, so we could now move on. So a lot of people don't understand the value of tax planning. A lot of people see tax planning as a high price tag. I have personally sold tax plans for $10,000, $20,000, even $30,000 tax plans. And some people see that as not being worth it, but you have to see it as an investment, right? So, for example, do you guys think it's worth the investment if you paid for a $10,000 tax plan, but it's going to save you $40,000 in taxes? Obviously, the answer is yes. It's all about the return on investment. So another thing when it comes to evaluating a tax plan is that some tax plans require spending and some tax plans do not. For example, some of the tax plans that require a cash outlay is stuff like buying a short-term rental, doing a 1031 exchange, making retirement contributions, and setting up charitable donations. So I would just say that these to some people are less desirable, especially if people don't have the liquidity to do so. So that's always our second option. Our first option when it comes to tax planning is looking for strategies that do not require a cash outlay. For example, doing a step-up in basis. Like for example, when somebody inherits a property, that's when you do or changing the legal entity type of the business to save more money, and also grouping elections for your portfolio and the timing of the income and expenses. Those tax strategies do not require cash outlay, so they are more desirable for a larger group of our clients compared to strategies that do require cash outlay. So examples of a high value tax plan. One example is a short-term rental loophole. Out of curiosity, who here has short-term rentals? Who here has Airbnbs? Nobody has Airbnbs here? Okay. So one of the biggest advantages of owning a short-term rental is that normally you cannot offset your passive losses from your real estate from your active income. When I say active income, that means your W-2 job, that means your business. But if you have short-term rentals, what's cool is that as long as you spend 100 hours on your short-term rentals, you are able to offset your active income, Esmeralda, with your short-term rental losses. So, for example, let's say you make $200,000 from your W-2 job, and then let's say your short-term rental makes $50,000 loss after depreciation. What's cool is that you can offset your $200,000 W-2 income with a $50,000 loss from your short-term rental, so then you're only going to get taxed on $150,000 instead of the full $200,000. which is very cool.
So you talk about the 100-hour rule in order to offset the income, I think like you said, with the short-term rental.
Yes, yeah. But when it comes to long-term rentals, it's a much harder. Instead of 100 hours, you need 750 hours of real estate hours, and you need to spend 51% of your time towards real estate and 500 hours towards your own personal real estate. So it's a much higher standard than that. When it comes to selling properties, you guys already know a lot of this, 1031 exchanges, property donations, right? So if you donate one of your properties to, you can avoid the capital gain from that charitable donation of the property. Plus, you can get a deduction of the fair market value of the property on the time of the donation.
Remember when he said that there's gonna be a trivia?
Yes.
That's the answer, C.
Okay.
No, just-
And then lastly, there's also swap to drop. So like, if you've never heard that, people ask me after this presentation because we're running out of time. When it comes to more active income, like flipping and wholesaling, something that we can look into is changing their legal entity to help lower their self-employment tax.
It's time to sit, reflect, and add. Doing taxes ain't so bad.